amid the broader rally. My next guest continues to see value in some small caps and has his eye on several under-the-radar names he thinks could see big returns this year. Gabelli Funds' Kevin Dreyer joins me now at Post 9. Kevin, good to see you.
Good to see you.
It's been easy to, I think, point to the small, mid-cap areas of the market and say, oh, there's a lot of hunting to be done there. It looks like there's good valuations. They've been somewhat neglected. But I like that you kind of look at it with a catalyst in mind, to some degree anyway, because I always feel as if you should go to a small cap CFO and say, why hasn't private equity bought you yet if you're so cheap? Or, not that's to exaggerate. But how do you approach that, and what are you finding right now?
Yeah, so our approach is what we call private market value with a catalyst. So we try to look at a company and decide what would a private equity firm or a strategic buyer pay to own the whole business, and then look for catalysts like a takeover or financial engineering, but sometimes just things as simple as new management or a change of cash flow allocation that could narrow the discount to what we think that stock is worth.
I know you actually had a company that just announced it was getting taken out today.
Yeah, so Kaman, which is an aerospace supplier, they announced that they're being bought out by a private equity firm. The stock's basically double where it was trading yesterday as a result, and I think that highlights, number one, the attractiveness of that general market. A lot of aerospace suppliers, notwithstanding some of the issues Boeing's had recently, have very, very attractive businesses, and it's got long-term tailwinds behind them, but also that valuation gap in a lot of those small cap names that can be surfaced.
What other kinds of timely ideas do you have? I guess obviously a company that's going to remain public for a little while, people can buy them.
Yeah. So last time I was here when rates were a point or so higher, with Scott, I talked about two companies, Bellring Brands, which makes premier protein shakes, and Atlanta Braves Holdings, and both of them as potential takeover targets. Interestingly, both went through financial engineering themselves. Bellring was spun out of Post. They were first IPO'd and then spun off. Atlanta Braves Holdings is part of Liberty Media. They did a split-off transaction. So they're both pure-play companies now. Bellring in particular, they're going to come up on the 2-year anniversary of the spin in March, which has certain potential tax advantages associated with it. So that might be the start of where bidders look to come in and buy that one.
Sure. As you look at these companies, is your premise that the economy is going to continue to be good and we can plug that into the earnings models, or do you have a macro feel at all for how things are going to go?
I mean, we're very bottom up when we look at companies. We look at a variety of scenarios. We'll probably have a base view, I'd say, personally from the inflation situation. Obviously, it's come down a lot. Wages will probably be a bit stickier. Market might have gotten ahead of itself in terms of expecting so many rate cuts this year in such a quick manner. So we'll see how that all plays out. But we tend to really like companies that will do well regardless of the environment. I look at, and especially when they're doing things internally, like Spectrum Brands, for instance, is another one, not necessarily a takeover target, but they had a business that they sold. It was their hardware and home improvement business. For over $4 billion, went to a net cash position. They say they want to go to 2 to 2.5 times net debt to EBITDA. They've got another small appliance business that they could potentially sell off too. You're left with a pet business and a home and garden business, and with pretty reasonable assumptions, you can get to a much higher stock price than it is currently if they take all that cash and they buy back stock.
Yeah, that's sort of, I guess, maybe a former roll-up of consumer brands. They had a bankruptcy. They came out of bankruptcy. So there's been a lot of moving parts in that
Exactly, but they've been slimming down and shedding off the pieces over time.
Interested in your take on Campbell's Soup. It's obviously a somewhat bigger company. This has been an out-of-favor group. People worried about loss of pricing power. What's attractive here?
Yeah, so first of all, the whole food and beverage sector had a tough 2023, and it was really a perfect storm of a few things. The companies had raised prices very aggressively to cover input costs going up, so volumes were declining, and that hit with all the news on GLP-1s and what that might do to their business. That didn't really affect the results, but the volume declines from the price increases, I think, combined with that narrative and just really hit the stock prices. But multiples came way down. Campbell's in particular, they're buying Sovos, which that deal's not completed yet. I think it gets done. It may or may not get done. But they own Rayo's pasta sauce, which is growing very, very well. That'll help their revenue growth. And what they might do as a next step after they complete that would be to potentially split up that business. They have a snacking business, which those companies generally garner much higher multiples than other businesses. And then I'd say generally, looking at the economy, if we do have a somewhat soft economy, we might see more eating at home. So as we lap those volume declines, it starts to be easier comps, and we might see good results, especially with the costs coming down.